A question a lot of people have about the stock market is, what's its average return per year? The first thing you really have to do to answer that question is define what the market is. A lot of people will refer to the market as the S&P 500. But what the S&P 500 is, it's the largest 500 stocks traded in the US. There are about 3,000 stocks, give or take. Don't hold me to that exactly. About 3,000 stocks in the United States you can trade. Globally, there are many thousands of stocks. So when you define when you say what's the average market return, you have to be careful in really defining what you actually mean. So I just looked it up, and it turns out the average return for the S&P 500 over the 90 plus years that it's been around is about 9.8%, according to CNBC in 2017. Now, 9.8% a year is a fantastic return, and it kind of lulls people into a false sense of security. They just think, well, I'll put my money in maybe for a year, maybe up to 5, and I'll get about 10% per year. But this is totally the wrong way to look at it because it doesn't account for risk. And if you want to get more technical, the volatility of the returns. This return has a volatility of about 20% per year. Let's break that down and see what that actually looks like. So the higher the volatility number, the more risk you're going to have in the short term for negative returns. And risk can actually mean the same thing for positive returns, but of course, we would like positive returns. So we're most concerned about this row here, this loss column. And it's broken out by the number of years in the market. And I got this from themotleyfool.com, and it kind of breaks out returns by holding period in the market. So you can see over a 1 year period, the worst you ever did was negative 38. The best you ever did was positive 53. If you have a longer time horizon, say 5 years, the worst you did was negative 14% every year. The best you did was plus 24% every year. Even at 5 years, that still seems pretty risky to lose 14% annually. That's going to hurt. We'll go out to 10 years. The worst period that Motley Fool uncovered was negative 4% every year. But you might have got 18% per year. So you can see as a trend, the further out you go and the longer you hold stocks, generally the less risky they become, right? Because this variance between your best and worst periods shrinks. And that's what we want. So that's what I say when you're thinking about holding stocks for a very short time horizon, just know that it's very possible that you can lose and lose big by doing that.